The crash had already happened. By the time I opened the charts, XRP was sitting at 0.30, a violent wick buried under a sea of red candles. Liquidations were flashing across derivatives dashboards. Retail sentiment had flipped from optimism to panic in less than an hour. Twitter was screaming SEC lawsuit expansion, emergency injunction, exchange delistings incoming. But the strange part? The order books weren't chaotic. They were quiet. Too quiet. I watched as millions in sell orders vaporized into thin liquidity, only to be absorbed almost instantly. No cascading failure, no structural collapse, just a controlled bleed, like someone knew exactly how deep to cut without killing the patient. The headlines blamed SEC rumor escalation, anonymous sources, regulatory whispers, nothing confirmed, yet the market reacted as if Judgment Day had arrived. And that's when I noticed something no one was talking about. While retail was panic selling into the abyss, whale wallets were accumulating, not slowly, aggressively. Hundreds of millions in XRP shifting off exchanges during the very hour fear peaked. That wasn't panic, that was positioning. And the more I dug, the clearer it became. This wasn't a collapse, it was a transfer. And if I'm right, what just happened at $30 wasn't the end of XRP. It was the setup for the biggest reversal crypto has ever seen. Let me show you what I found. It started with a post. One legal analyst hinted at renewed SEC pressure surrounding XRP's classification. No formal filing, no official statement from the U.S. Securities and Exchange Commission, just speculative language amplified by influencers hungry for engagement. Within minutes, algorithms picked it up. Keywords triggered risk models, SEC, enforcement, emergency motion. Automated sell programs reacted before humans could process context. I watched derivatives funding rates flip negative almost instantly. Longs were over-leveraged after weeks of slow upside grind. All it needed was a spark. That spark turned into forced liquidation. But here's what bothered me. If this were real regulatory escalation, we would have seen coordinated exchange halts or official clarification. Instead, silence. Regulatory silence. Corporate silence. Even Ripple's channels stayed calm. The market wasn't reacting to fact. It was reacting to fear. And fear, when timed correctly, becomes a tool. The speed of the drop felt engineered, not organic, not chaotic, surgical. Because when panic is synchronized, someone profits from the precision, and someone did. The wick to 0.30 wasn't random. That level had historical liquidity clusters, old consolidation zones, stop-loss concentrations, liquidation pockets stacked from months of leveraged positioning. It was a magnet. I pulled up liquidation heat maps. The density around 0.32 to 0.29 was thick. Retail traders had anchored their stops there, convinced support would hold. It didn't. Price sliced through like it wasn't even there. But instead of continued collapse, something unexpected happened. Absorption. Massive buy walls appeared off-book, hidden liquidity, orders large enough to halt the freefall without creating a visible footprint. The type of activity you don't see from emotional traders. I checked on-chain flows. XRP was leaving exchanges. Fast, cold wallets associated with long-term holding patterns began receiving massive inflows within the same 30-minute window as the crash. Retail was selling market. Smart money was buying limit. And the most telling detail, there was no follow-through dump. If this were real structural fear, price would have cascaded lower. Instead, it stabilized unnervingly fast. Like $0.30 wasn't a failure, it was a target. And someone hit it perfectly. What fascinated me wasn't what institutions said, it was what they didn't. No public distancing from XRP, no emergency risk memos leaked, no exchange delisting rumors confirmed. Even major platforms kept trading uninterrupted. When regulatory risk becomes existential, institutions protect themselves immediately. They overreact, they distance, they hedge loudly. This time, silence, calculated silence. I monitored OTC desk chatter and volume discrepancies. Spot exchange panic didn't match OTC demand flows. Large block trades were settling quietly in the background. Institutions weren't fleeing, they were negotiating. Here's the uncomfortable truth. Large capital doesn't chase green candles, it accumulates during controlled fear events, and this crash, it was controlled. The wick hit exactly where liquidity was deepest. It reversed before systemic damage occurred. It triggered maximum emotional capitulation without breaking structural market integrity. That's not random, that's engineered efficiency. And if institutions were absorbing supply at 0 at 30, they weren't doing it for a 10% bounce. They were positioning for something much bigger. The kind of move you only prepare for when you believe clarity is coming. I watched retail sentiment collapse in real time. Telegram groups flipped bearish within minutes. YouTube thumbnails changed from XRP breakout incoming to "Is this the end?" almost instantly. That's how fragile conviction is when it's built on price, not structure. Retail traders operate emotionally. They anchor hope to green candles and abandon it when red appears. When the wick hit 0 by 30, it wasn't just a price level breaking. It was belief breaking, and belief, once shattered, creates supply. I saw long-term holders posting sell confirmations, years of conviction liquidated in seconds because of an unverified rumor. That's the power of regulatory fear. But here's what retail missed. The same wallets that accumulated during previous SEC volatility were active again. History was repeating, not as chaos, but as strategy. While retail dumped to avoid total loss, larger players absorbed inventory at generational discounts. And markets don't reward fear, they reward patience under pressure. The psychology shift was complete. Now the supply was in stronger hands, and that changes everything. The blockchain doesn't panic, it records. And what it recorded during the crash told a very different story than the headlines. Exchange outflows spiked dramatically during peak fear. Not inflows, outflows. That means accumulation. Dormant wallets woke up. Addresses that hadn't moved XRP in months suddenly activated, consolidating positions. When long-term holders increase exposure during regulatory rumors, it signals conviction at a level most retail traders can't comprehend. I traced wallet clustering patterns. Accumulation wasn't fragmented, it was coordinated, structured, timed almost precisely with liquidation waves. Someone had prepared liquidity in advance. That implies expectation. You don't deploy nine-figure capital into uncertainty unless you believe the uncertainty is temporary. And if regulatory clarity was truly negative, insiders closest to risk wouldn't be expanding exposure, they'd be reducing it. Instead, supply shifted from weak hands to entities comfortable holding through volatility. That transfer doesn't happen by accident, it happens before narrative reversal. And narrative is the final weapon. 3 hours after the crash, subtle changes began. Legal analysts softened their tone. Clarifications surfaced. The original SEC rumor lacked documentation. No official filings. No enforcement action. Just speculation amplified into panic. Price began reclaiming levels methodically. No explosive V-shape, just steady reclaiming of structure. That's accumulation behavior. Media outlets that fueled the fear pivoted to neutral language. Market overreaction. Traders digesting regulatory uncertainty. Digesting as if the market hadn't just been forced into capitulation. Here's what most don't understand. Narrative lag is deliberate. First comes fear, then positioning, then clarity. By the time clarity arrives, price is already higher, and those who sold into panic become future buyers at worse prices. The reclaim of 0.40 wasn't random. It was confirmation that 0.30 had served its purpose. Liquidity harvested, positions built, weak hands removed. Now the board was reset, and reset boards precede aggressive moves. Institutions don't focus on hourly charts, they focus on resolution timelines. The long-running tension between Ripple and the U.S. Securities and Exchange Commission has always been about clarity, not destruction. Markets price uncertainty harshly, but they price certainty explosively. If large players believe regulatory overhang is nearing conclusion, whether through settlement, legislative framework, or judicial narrowing, then volatility becomes opportunity. The $0.30 flash crash may have been the last liquidity sweep before structural clarity emerges, because once clarity hits, accumulation becomes chasing, and institutions hate chasing, so they buy when it feels uncomfortable, when social feeds are screaming collapse. When retail conviction fractures, that's when positioning is cheapest, and positioning, when paired with narrative shift, becomes fuel. fuel for something far larger than a relief bounce. Now prices stabilizing, funding rates are neutralizing. Sentiment is still fragile, which is exactly how major reversals begin. If XRP reclaims pre-crash levels and holds them, the narrative flips from SEC threat to SEC scare failed. And failed breakdowns are among the most powerful bullish signals in markets because they trap shorts. They force re-entry from sidelined capital. They expose manipulation attempts. The flash crash to 0.30 might not be remembered as a collapse. It may be remembered as the final shakeout before institutional participation accelerates. But here's the warning. If you trade headlines instead of structure, you become liquidity. If you sell fear instead of analyzing flows, you become exit volume. The market doesn't punish ignorance, it exploits it. And what happened at 0 and 30 wasn't chaos, it was selection. The biggest reversals in crypto history never start with optimism, they start with doubt. And right now, doubt is everywhere. That's exactly why I'm paying attention.